Hello everyone, warm welcome to Textbook Super Coaching. My name is Madhav. I welcome you all in the next session where we are going to discuss the weekly RBI current affairs. As you all know that whenever we are preparing for RBI and other regulatory body exams, we know this very well that the examination is based on a very important area, that is finance. And in major areas, n number of questions will be asked from the finance itself, and that too current affairs is going to play a really very important role. In order to cover the current affairs for you all, we at Textbook, we have started with a series, I would say a weekly series, where we are covering the weekly current affairs for not only RBI but that too for finance, ESI, important government schemes, reports and indices, as well as the weekly PIB analysis is also discussed with you all. So before we start the discussion, may I have a reply in the comment section that I'm audible, visible, everything is fine, we are good to go, so that we can begin the discussion without any further delay. Today's session is going to be really very important because in today's session we won't only discussing the important news of the week. Along with that, we will be discussing the important terms which are generally there in your finance related topics. So we will be discussing them as well. So this session is not only to cover the current affairs, it will help you to understand the basics as well. The way the term I use basics, you will get to know in some time why I'm saying that, how we are going to cover the basics, that wala part will be discussed. So let's get started guys without any further delay. So the first point from where I'm going to start with is, as I have already discussed with you, these are the weekly sessions which are aligned for you at same time, that is 6 p.m., where we will be covering the weekly PIB analysis along with weekly finance, RBI updates, government schemes, ESI, and many more. Okay. So if I start my discussion, what I have done is I have taken a screenshot of the RBI press release. The moment you will open the RBI website and you click on the press release, this is the latest area which we are going to cover in today's session. If you check this very closely and clearly, there is a news, I would say twice this has been mentioned in the past 1 week, that is related to premature redemption under sovereign gold scheme. Now the question is, so what is this sovereign gold bond scheme, why it was introduced, when it was introduced, and what is the actual meaning of the term, that is sovereign gold scheme. Along with that, what is sovereign gold bond, and then we will be discussing the meaning of redemption, that what is redemption, and then I'll make you understand what is the meaning of premature redemption. This is how we are going to start with our discussion. So first of all, if I start my discussion with the first term, that is sovereign gold bonds. What are sovereign gold bonds? See, the word sovereign basically means it is not influenced. Sovereign means it is not influenced by any external power. It is being controlled, it is independent, and it is under the government of India itself. Second point is gold bond. So gold bond basically means, see, India is one of the largest consumer of gold in the world. And you might be thinking that if India is the largest consumer of gold in the world, that is because of the ornaments and jewelry consumption. I would say no. In India, certainly the consumption of gold for ornaments and jewelry is quite high. But along with that, there is one more area which we generally miss out when we check out the consumption of consumption of the Indian market related to gold. Then the answer to that particular question is investment. In India, 80%, or I would say more than 80% of gold consumption is basically done for the purpose of investment. Investment basically means, we know that gold prices, they fluctuate, and they fluctuate as per the international standards. And keeping that in mind, many investors in the country, they invest their funds. Many investors in the country, they invest their funds in they invest their funds in the commodity, they invest their funds in gold for in order to earn profit in the near future. For example, today the gold price is, let's say, I'm just taking an example, that is 70,000 for per 10 gram gold, and in the near future it may increase to 80 to 85,000, and I will be selling my 10 grams of gold and earning the profit. As well as it is one of the safest, till now we can say it is one of the safest mode of investment which gives you short return as per the past analysis. Keeping this point in mind, government came up with an initiative where government said that rather than purchasing a physical gold, why? See, if you are purchasing a physical gold and that too with the sole motive of investment, you purchase the gold and keep it in your locker, that gold has vanished away from the economy. But India is consuming gold, or India is one of the largest consumer of gold. Simultaneously, there is one more problem, that is India is one of the largest importer of gold as well. So in order to tackle down the imports of the country, this initiative has been taken where government introduced a term that is sovereign gold bond. So sovereign gold bonds, these are basically papers. In very simple terms, I would say these are basically papers which represent gold. How I'm saying that paper represents a gold? So on a bond, it will be mentioned that, let's say it's a bond of 10 grams gold. That means you will be purchasing this paper at the market price of gold today, and at the time of maturity you will be selling the same bond, you will be selling the same bond to RBI, because RBI is the issuer of these bonds, and at the time of maturity you are selling the same bond, but that too at the current market price. So you purchased at the market price, and after maturity or after the time period or after the locking period is done, then you can, I would say, sell it back to RBI, and that too again at a market price. So if you are keeping a physical gold or you are keeping the paper bonds, the return is going to be same. But there is one clause, the clause of locking period. There is a locking period in case of these bonds, but to overcome this locking period issue, what government has done, government has allowed the trading of these gold bonds on the stock exchange. The way you trade in your shares, the way you sell out your shares, in a similar manner you can sell these bonds as well whenever required. That means before maturity you can sell the bonds in the stock market. Secondly, government is giving you a benefit that on these bonds we will give you a fixed interest rate. This fixed interest rate is beyond and separate from the gold price fluctuation. That means the investment you have done, on the done investment you will be earning a fixed return, that is the interest rate, and along with that your bond price will increase in similarity to the physical gold price in the market. So let's start the discussion. Sovereign gold scheme was introduced when? Sir, it was introduced in November 2015. Why it was introduced? It was introduced in order to decrease the demand for physical gold, specifically for the purpose of investment, and redirect the domestic savings into the Indian economy by purchasing these bonds rather than purchasing the physical gold. Remember that when we talk about these government bonds, so these gold bonds, they are issued by the government. They are issued by the government, or I would say they are issued by RBI on the behalf of the government. They are issued by RBI on the behalf of the government, and they are issued under the Government of India stocks, which is as per Government Security Act 2006. So this is a very important part which can be asked in the examination. If someone asks you that in India, government bonds are issued. Yes, sir, government bonds are issued in India. These government bonds are issued in India, but the question over here is, sir, they are issued under which act? Sir, they are issued under Government Securities Act 2006, and they are issued by RBI on the behalf of the government. They are issued by RBI on the behalf of the government. Now, from where you can purchase these bonds? So you can purchase these bonds from your commercial banks, but you cannot purchase them from small finance banks. You cannot purchase them from payment banks. You cannot purchase them from regional rural banks. So except regional rural banks, small finance bank and payment banks, rest all the commercial banks, they are allowed to sell the government bonds. Along with that, we have Stock Holding Corporation of India Limited, Clearing Corporation of India Limited, even the designated post offices, National Stock Exchange and Bombay Stock Exchange, they are selling the bonds directly or indirectly with the help of the agent. So these are the, I would say, shops. In very layman terms, these are the shops where, yes, government bonds or sovereign gold bonds are available. You can purchase the sovereign gold bonds from these shops. Now the question is, who all are eligible to purchase these bonds? So you and me, that means yes, the individuals are eligible. Along with individual, Hindu undivided families, that means if you have a PAN under HUF, that is Hindu undivided family, then also you are eligible. Trust, universities and charitable institutions, they are eligible to purchase these bonds. But the question is, so what is the limit up to which an individual can purchase? Along with that, sir, what will be the price of this particular bond? Along with that, sir, what is the minimum and maximum limit till which a purchase can be done? Let's discuss that. If I talk about the issue price, sir, issue price is the price of the gold is linked to the price of gold triple line, that means 24 karat gold, as published by the Indian Bullion and Jewelry Association, Mumbai. So we have an association, that is Indian Bullion and Jewelers Association, which publishes the price of 24 karat gold, and the same price will be used, or at the same price you can purchase these sovereign golds, which are sovereign gold bonds, which are available in the market. The next point says, so what is the investment limit? As I said, everyone can purchase these bonds, and these bonds are available with the smallest unit of 1 gram. So what is the smallest unit? So the smallest unit for purchasing the sovereign gold bond is 1 gram. That means you can purchase a sovereign gold bond equivalent to the value of 1 gram. Now, if you are an individual, then in that particular case, in case of individual and Hindu undivided family, how many or up to what value of gold bonds you can purchase? So you can purchase maximum 1 kg, that means from 1 gram to 4 kgs. I'm sorry, not 1 kg, 4 kgs. From 1 gram to 4 kg is the limit for the individuals as well as for the Hindu undivided family members. But on the other side, if I talk about trust, so trust can purchase up to 20 grams, up to 20 kilograms of gold bonds. Now the question is, sir, this limit is for what time period? So this limit is for 1 financial year. That means in 1 financial year, an individual can purchase from 1 gram to 4 kgs, and a trust can purchase from 1 gram to 20 kgs of gold in 1 financial year. So the minimum investment which can be done in the sovereign gold bonds is 1 gram. Maximum by an individual is 4 kg, maximum by HUF is 4 kg, maximum by trust is 20 kg in 1 financial year. Now, sir, in the starting you said that these government bonds or the sovereign gold bonds which we talk about, these sovereign gold bonds which you talk about, sir, they have a maturity period. They have a maturity period. Recently in FCA, they asked the limit. Okay. That means this session is beneficial for you. So as one of the student replied in the comment section, the same question was asked in the examination. That is the reason I'm discussing these areas with you. See, I can come up with the news directly. मैं सीधा भी आपको news बता सकता था. I would have covered the news directly, but rather than covering the news directly, if I'm giving you the context as well as the concept of the term which we are going to discuss, that will help you to answer the other questions as well. So if someone asks you what is the term of government sovereign gold bonds, then the answer is that the term of gold bonds is 8 years, but you are allowed to exit. You have an option to exit your investment after 5 years. That means if someone asks you what is the maturity, sir, actually the maturity is 8 years, but yes, you are allowed to exit after 5 years. So that means minimum maturity is 5 years and highest or maximum is 8 years. As I said in the starting itself, that not only you will be enjoying the gold price fluctuation, you will also receive fixed interest rate on your investment, and the fixed interest rate on your investment is going to be 2.5% per annum, as it is 2.5% semi-annually, as it is clearly mentioned on the sovereign gold bond. What does it mean? It means, let's suppose today you have purchased a sovereign gold bond, and that too of 10 grams, and after 5 years, if you want to exit the scheme, you can sell the government bond, or you can reach to RBI and sell out your gold bond. Then RBI will pay you interest, which is 2.5% calculated semi-annually, plus RBI will pay you the market price. So your current return is going to be even higher than the physical gold price in the market. Remember that sovereign gold bonds, they are exempted from the capital gain tax. So you when you purchase these government bonds and then you sell these gold bonds, at the time of sale, the profit you are going to earn, on that profit, capital gain tax will not be charged, which is unlike in case of physical gold. If you purchase physical gold and you are selling the physical gold after 2 years, on the profit you are supposed to pay the capital gain tax, which is not the case in case of sovereign gold bonds. And that is the reason investors, they should invest in the sovereign gold bonds, because it's going to give them a better facility. Now the question is redemption. So this question was, or this term was introduced in the starting by you. What is the meaning of redemption? See, redemption basically means when you purchase, let's suppose on what is the date today? Today is 18th September. Let's say on 18th September 2024, you reach to RBI and you purchase these bonds, and after 5 years you want to exit. The moment you want to exit, what you will do, so you will sell out or you will give back the bond and you will receive the funds. So this process where you receive the funds against your bond, that means you are now going to redeem your bond. That means you are redeeming your bond, you are redeeming your investment, and you will be getting the return, which include two things. First thing, it will include the interest value on it. Along with interest value, it will give you the same price as that of the market price of gold. But there are certain disinvestments. First disadvantage is, unlike physical gold, you cannot sell the government sovereign gold bonds on the very next day, but you can do it for your physical gold. That is the first point. Second is, although RBI and government has allowed that you can trade your sovereign gold bonds from the very next day in the stock market, but the count of buyers in the stock market is quite low, because of which the customers, or I would say the investors, they find it difficult to sell it before maturity in the stock market rather than to the RBI at the time of maturity. So these are the two disadvantages. Now I will jump to the news. What was the news for the day? So the news is, on 17th of September 2024, two sovereign gold bond series which were issued in 2016-17, and it was series 4, as well as 2019-20 series 4 are up for the early redemption, which means if you have purchased this bond in 2016-17, you can redeem it today after 7.5 years. And if you have purchased it in 2019-20, then you can redeem it today after 5 years. So there are two options. If you talk about the one who has purchased these bonds in 2016-17, you know what? They have purchased 1 gram bond for 2943 rupees. They have purchased 1 gram bond for 2943 rupees, and now they are going to receive a return of 7196 rupees, which include I would say the return value at around 149% above the original issue price. So above the original issue price, you are getting 149% of return. And if I talk about the one who has purchased the same in 2019-20, they have purchased 1 gram of bond at 3890 rupees, and now they can redeem it for 7278 after 5 years. And you can easily check the value of return here also. The value of return is close to 200%, and here the value of return is more than 200%, which include your current physical gold price, or it is on the current physical gold price, as well as it will include the interest values as well. So for investors who want to seek early exit, that means you want to exit from the bond before 8 years, what you can do is, so you can choose the buyback facility which is available, buyback facility which is available after 5 years. So on the 5th year or 6th year or 7th year, you can raise the request, and RBI will consider the request, and on the basis of considering the request, RBI will redeem these bonds, and these bonds can be redeemed even before maturity. So when you redeem your bonds before maturity, that is known as premature redemption. So recently there was a news that RBI has announced premature redemption of sovereign gold bonds which were issued in series 4 in the year 2016-17 as well as in the year 2019-20. Got it, guys? Is it clear? I hope this point is very much clear. Now, I give you one more important point over here, which is really very important. In this year's budget, government has not made anything clear on the sovereign gold bonds. And since this financial year has started, since 1st of April, RBI has not issued the sovereign gold bonds. So RBI has not issued the sovereign gold bonds, which means government is in a dilemma whether to issue these bonds in the near future or not due to a number of reasons. Once the government will take the decision, then we will be discussing in detail that what were the reasons due to which this decision has been taken by the government. Got it, guys? So what is sovereign gold bond? It is clear. What is premature redemption is clear. How this premature redemption can be done? What you need to do is you can apply, and once you have applied, then RBI will be taking up the steps in order to redeem your premature bonds. The next is change in public holiday under Negotiable Act, Instrument Act, no transaction and settlement in government securities, forex, money market on 18th of September 2024. This is very important point. This press release is important for you to understand a very important concept, and the concept says maybe because of too much, maybe that could be a reason, but here what you need to understand is one very important point, and the important point says whenever we talk about the bank holidays, if someone asks you, sir, who decides the bank holidays? Then bank holidays, they are officially decided by whom, sir? They are officially decided by RBI. And RBI has this power to decide. RBI possesses this power to decide the banking holidays under the Negotiable Instrument Act 1881. So recently in September 2024, Government of Maharashtra declared September 18, 2024 as public holiday. And the moment this date was announced as a public holiday, earlier the public holiday was 16th of September 2024. That holiday was cancelled and 18th of September was included, and the required I would say notification was given by RBI. So this news is not important. 18th of September or 16th of September is not important. What is important for you is, sir, who is responsible to decide the bank holidays? The answer will be, sir, RBI is responsible. Sir, RBI decide these bank holidays under which act? So that will be Negotiable Instrument Act. Earlier, RBI mentioned 16th September as bank holiday, but Government of Maharashtra changed it. If I'm not wrong, it is because of the festival which is going on related to Ganesh ji. So maybe for that reason this change was done, and due to that change was recorded under the Negotiable Instrument Act, and no bank transaction or settlement was done on 18th of September as it was included in the circular, or it was announced by RBI. Moving on to the last news of the day. When I was going through with the press release, there is a news, or there is a regular news on two terms. One is VRRR, other one is VRR. But this one is a very important news, and I always find a press release on VRRR, and when I opened it, this was the screen I received, and I was very confused that what is it. So in order to help you guys to understand what it basically is, you must be knowing two terms. One, you know repo rate. So repo rate is the rate of interest. Repo rate is the rate of interest at which banks, they can borrow funds from RBI, and that too with the help of government securities. And second one is reverse repo rate, which means banks, they can park their excess liquidity with RBI, and RBI will pay them with the return. Now, repo rate is allowed, or you can enjoy the facility of repo rate up to a predefined limit. Now, if bank is in need of funds, then bank can approach to RBI, and bank can ask RBI to provide loan. And if RBI is not in a position to give you loan at repo rate because of your limit exhaustion, then RBI allows you to get into the auction format, that is variable repo rate, where the banks, they come up with the auction and they come up with the bidding where they are agreeing, or they are ready to borrow the loan from RBI even higher than the repo rate. Similarly, reverse repo rate is low at 3.35% if you remember, but RBI has given one more term, that is variable reverse repo or variable repo reverse rate. What is it? Basically, it basically allows the banks that they can park their funds with RBI, but the rate of interest will be higher than reverse repo rate, and the parking of the funds will be done for more than 14 days, generally 14 to 56 days. And this term has been introduced by RBI in order to ease the banks, or to absorb the excess liquidity in the banking system. So that is the reason these kind of press releases, they come on regular basis, that result of 3-day variable rate repo auction. That means cutoff rate was, actually repo rate is 6.5%, but here the cutoff rate is 6.51%, and weighted average rate was 6.55%, which means banks are ready to borrow the loan from RBI even greater than or higher than the value of repo rate. Same goes for VRRR, where RBI is ready to receive the funds from the banks even higher than the value of reverse repo rate, but not for a day or two, but for a long period, long in the sense 14 days to 56 days. So these are the two terms. Whenever you come across with these two terms, don't worry, these two terms are now clear to you. It has been made clear to you by Madhav sir. If you want to learn all these concepts, and that too in much detail, then we at Textbook offering you RBI Grade B 2025 Lakshya batch. You can enroll in this particular batch and you can assure short selection in RBI Grade B 2025. In order to purchase this batch, you can use a code. At the time of applying the code, you can use a code Madhav, and the moment you'll use a code Madhav, you will enjoy the maximum discount on the given course. So you can download the PDF of this session from my Telegram channel. Hope you must have enjoyed the discussion. So from today's discussion, you have learned three new things. First is, what is sovereign gold bond? That term is clear to you. Then all the nitty-gritties related to sovereign gold bonds are clear. What is premature redemption is clear in general, and what is the premature redemption of sovereign gold bonds is clear. Secondly, who decides the bank holidays? RBI. Under which act? Negotiable Instrument Act. That is clear. Third and the most important part is, what is repo rate, what is reverse repo rate, what is VRR, and what is VRRR. These three terms were new maybe to you, but today they are also clear in this particular discussion. So that will be all. We'll catch you in the next session at 8 p.m. where I'm going to discuss capital adequacy ratio. So don't forget to join with me today at 8 p.m. in order to cover your very important topic, that is capital to risk weighted asset ratio or capital adequacy ratio. Thank you so much for joining. Good luck. God bless you all.